Hello, investors. Welcome to the podcast for the month of March. We know there is a lot of uncertainty in the markets with the SVB bank collapse in the US and its potential impact on global markets, global economy, and Indian markets per se. So let's try to demystify what's happening there at SVB and if there will be any impact on our economy and markets. So the startup focused lender SVB became the largest bank to fail since the 2008 financial crisis, which was a sudden collapse that impacted global markets and leaving billions of dollars belonging to companies and investors stranded, which were deposits in that bank. So this bank based in Santa Clara was ranked as the 16th biggest in the US at the end of last year with about $209 billion in assets. The banking regulator closed the bank and appointed the Federal Deposit Insurance Corporation as receiver for later disposition of its assets. So the depositors were kind of strangling with their deposits stuck. So specifics of the collapse were a jumble, which we'll come to later, but the Fed's aggressive interest rate hikes this year, which have crippled financial conditions in the startup space, in which this bank was a notable player, seemed at the core. As it tried to raise capital to offset fleeing deposits, the bank lost $1.8 billion on treasury bonds, whose value were significantly impacted because of the interest rate increases by the Fed. So the current SVB fallout in certain ways, like what we saw last year with the UK pension funds, is amid losses due to higher interest rates. We expect if the Fed continues to hike, we will find other pockets of losses on long duration strategies that have used leverage. While it is always hard to know how much pain is too much for an economy or a financial system to bear, the rapid succession of losses coming to light may suggest that we are close to reaching a level of interest rates that probably is the tipping point. However, the 2008 situation was very different than what's happening here in 2023. People keep comparing it to the 2008 global financial crisis, but there are very huge differences between then and now. So today, banks have a much higher ratio of their assets in cash and treasury securities, which are nominally risk-free if held to maturity. Their asset base is also in better shape in terms of credit risk too. Banks have been more prudent in lending and have less subprime lending exposure. So what's causing the issue this time around? So issue is with liquidity and duration. It's a form of an asset liability mismatch. While banks' liabilities, that is, its deposits from its customers, could be called upon any time, it was invested in very long-term maturities, and that led to this issue. So some of the safest securities that a bank own might not have credit risk, but they do have duration risk. The Federal Reserve raised interest rates at the quickest absolute pace in decades. It was about a 4.5% increase in 1 year, making the bonds held by these banks unsaleable without a loss. So how the entire problem originated? So banks were given a ton of deposits during 2020 and 2021, thanks to the fiscal stimulus programs all run by the government and the Federal Reserve. And banks used those deposits to buy a lot of securities. And they were compelled to buy long-term securities, which offered relative better yields in an extremely low-yielding environment. If you remember, Fed funds rates were closer to zero at that time. So after a year of rapid interest rate increases, the prices of those fixed income securities are now lower than they were when banks bought them. Due to buying of so many securities when interest rates were low, they are now heavily discounted if they are to be sold. Banks have a lot of unrealized losses. Cumulatively, over $600 billion worth of unrealized losses sits in many of these banks. Normally, banks can hold those securities to maturity and get all of their money back. That's why they are classified as hold to maturity in their books. And unlike 2008, most of this has little or no credit default risk. So if they can hold on, they are fine. However, if depositors pull their money out of a bank above and beyond the amount of cash that the bank has on hand, then that bank might have to sell securities at a loss rather than hold on to securities until maturity is planned. So if that happens, it can turn a liquidity problem into a solvency problem, not because securities are defaulting like they did in 2008, but instead because the banks are selling otherwise high quality securities at a loss and locking in those losses. The unrealized losses become realized losses for banks that can't keep their deposits from running away. So due to the low credit risk of most bank assets, we certainly don't see it as a 2008 repeat like many would assume. Does this lead or endanger the whole financial system? No. And is it a serious liquidity concern for many banks which are not having huge cash deposits or liquid securities? Yes, it will. And that is why the Federal Reserve had to step in. So amid hawkish 50 bips hike that we were listening until the prior week and ongoing quantitative tightening, the Fed was forced to rescue with a new tool to save the billionaire tech depositors at SVB. The FDIC guarantee of all deposits at the bank it has taken over, combined with the Federal Reserve's new bank term funding program, allows banks to pledge treasuries at par for funding should contain the deposit flight contagion. The reaction in market has been dramatic, with expectations for the Fed's rate trajectory collapsing. The terminal rate has plunged from September 2023 at 5.7% last week, which is now expected to be at 5.15%, and expectations for rate cuts in second half are soaring. The odds of a 50 bips hike in March plunged from 75% to less than 20%, and even for May has collapsed for 50 bips to just 85% odds of a 25 bips hike, not a 50 bips hike. So perhaps a clear context, to give you a clear context here, in just 3 days, the market pricing of additional rate hikes here has gone down significantly. Now it is pricing in around 50 bips of rate hikes by mid-year and then rapid rate cuts. So many will blame everything except the perverse incentives and bubbles created by monetary policy and regulation, and will demand rate cuts and quantitative easing to solve the problem. But we think that it will only worsen the problem. You don't really solve the consequences of a bubble with more bubbles. So in a way, this is only going to push the can down the road rather than really resolving issues for the long run. So what will be the impact on Indian markets? Coming to equity markets, because we have seen some impact already in equity markets. The collapse of the SVB bank in the US has triggered a sell-off amongst global banking stocks, with investors worried about this contagion effect. US Fed's decision to backstop depositors helped contain some fears, but it's still, if you look at the banking stocks in India, are significantly down as compared to the broader market, where broader markets are down by about 1.5%. Indian stocks are down about 2.3, banking stocks down about 2.3%. So we think that our economy should not be much impacted. Banking sector worries have been overblown. There could be some impact on the tech sector, but we do not expect significant pressure there as well. Fundamentally, India has to do little with SVB or US banking system. And unlike the West, confidence levels in the Indian banking system remain high. Banks in India have good regulations and are in a good health. While further reactions and correction in equity markets can't be ruled out, it could be a good buying opportunity for one planning their allocation to equities, as fundamentally this crisis does not impact prospects for our economy and markets. We expect the cyclical recovery in India to continue over the next 2 to 3 years. Also, such shocks are a great reminder that you need to hold a good diversifier to risk assets, that is gold. As equity markets have corrected, gold has gone up, reflecting its characteristics as an ideal diversifier. So importantly, signifying the benefits of asset allocation for one's portfolio. So do build a portfolio like what we recommend. The 12, 20, 80 is an ideal setup, and these kind of corrections are a great opportunity to build your core allocation to equities. So happy investing. With that, I'll sign off and we'll be back next month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.